Today's webinar is entitled Navigating the Recovery, How Europe is Coming Out Stronger from the Pandemic, and is brought to you by the European American Chamber of Commerce, where Europeans and Americans connect to do business. This event is funded by the European Union. I'm Todd Schwartz, Executive Director of the Cincinnati chapter of the EACC, and I'll be your host today. We have over 200 registrants for today's event from across the United States and around the world, so I'm sure we'll have a vibrant and informational discussion. One quick disclaimer, please note, all comments and opinions expressed by our speakers today are their own, and they do not necessarily represent the views of the European American Chamber of Commerce or of its members. Let me now hand you over to Yvonne Bendiger-Rothschild. She is the Executive Director of the New York chapter of the EACC. She will introduce our topic and our speakers. Yvonne, over to you.
Thank you, Todd. Welcome to our program this morning. I'm glad so many of you could join us so relatively close to the summer vacation. Today's program, Navigating the Recovery, is, as Todd said, a part of an ongoing series that we're doing in collaboration with the European Commission, and it's funded by the EU. The theme of our program isn't the I told you so. It's about sharing best practices, how we're dealing with a global crisis like COVID-19, and what the EU and the US can learn from one another to effectively address the after effects of the crisis and probably more importantly, to better prepare for the next one. The EACC network is a platform for Europeans and Americans to meet and learn from another. Neither of us have the ultimate insight, but both of us have experts that can help our partners on the other side of the Atlantic. And this is the purpose. We are bringing together experts like Chris Orsini, the consul at the EU delegation in Washington, and his colleague, Ben Carlina, the senior economist at the delegation, together. And they will explain to us today what the EU leadership, together with the member states, experienced during the pandemic, how they will offer a comparison of how the EU tackled these challenges, also in relation to how the European Union addressed the last financial crisis and what the lessons learned were in comparison. We will talk about how the various member states are being supported and what has been done and what will be done to come out as a better union. We will have time for Q&A after the program, and you can submit questions during the discussion, and I will feed them into the conversation. With that, I hand over to Ben, who will set the stage for today's discussion and tell us, like I said, about the lessons learned from the debt crisis and how the EU acted faster and, I dare say, more synchronized to this crisis. Ben, over to you.
Thanks very much, Yvonne. I very much appreciate it. It's a pleasure to be here. I would like to just reiterate, we do hope that we get a good discussion here. So we're going to try to go pretty quickly in the presentation. But if you have questions, just send them via the GoToWebinar control panel, and we'll pick them up as soon as we can. So, all right, let's get started. So just to quickly review some of the public health stuff. The main point that I'd like to make here is that, in the initial outbreak, this hit, the COVID-19 pandemic hit Europe and the United States at similar, levels. If you look at the way that the new infections were increasing really, substantially in March. But the key point is that Europe went for early and comprehensive lockdowns and was much more successful than the U.S. in pushing cases down, quite quickly and quite dramatically. And what this allows you to do is it allows you to start doing contact tracing, tracking where people got sick, putting them into quarantine, into isolation, and that in turn allows you to reopen more quickly. So, for example, most schools have reopened in Europe now, and that's a really positive thing. It allows the economy to reopen as well. But of course, doing this means that you're going to, have a pretty serious economic disruption and put the economy into sort of hibernation. And these charts show you that, when people were told to stay home in Europe, they really did. The blue line is a mobility indicator showing how much people really started to stay at home, and the red line is, you know, what these government restrictions were in terms of, you know, keeping businesses closed and offices closed. One point I think that's worth noting here is that there's no real distinction between Northern Europeans and Southern Europeans in these charts. People did as they were told. They followed the rules, and if anything, the restrictions were even stricter in the South, because that's where the pandemic hit first, and it was a bit more difficult. But really what happened is that these restrictions, you know, paid off pretty well. This data is from Google's high-frequency mobility trackers that uses cell phone data. You can see here that there actually is a difference between behavior in Europe and in the US. You know, if you look at the chart on the upper left on grocery sales, there was no hoarding of toilet paper or flour, things like that in the EU, has happened in the United States. I don't really know why, but you know, it seemed to work pretty well. And so these lockdowns, they got the numbers down. They allowed people to start tracing the spread of new infections, and that meant that things could open up more quickly. One little caveat that I would note is that if you look at the workplace slide there in the bottom left, that little dip in activity at the workplace isn't because of new outbreaks or anything. It's just because of the more generous vacation allowances that people tend to get in Europe, and that's why they were staying home. Anyways, the thing is that these shutdowns, while they're very effective on a public health measure, it also means that you're going to get a pretty severe economic contraction. These charts are showing you purchasing managers' indexes, the PMIs for manufacturing and services. And if you compare the Europe to the US, the manufacturing PMIs, you know, fell back quite severely, but to roughly similar levels as we experienced during the Great Recession following the financial crisis. But the services PMIs have been much worse and suffered much steeper declines. This reflects the vulnerability of a lot of service sector industries to lockdowns and social distancing measures. So think about restaurants and retail and tourism. These sorts of businesses can't open when people are at risk or afraid of getting infected, or they operate at much lower capacities. So services have been uniquely hit both in the US and in Europe. However, in both sides of the Atlantic, note that we've got really, you know, V-shaped recoveries, that during the lockdowns, activity fell dramatically, but once you started reopening, there was a big bounce back in activity. One other thing I would mention is that the latest August flash PMIs, which are not included in these charts, have shown a little bit of a weakness in a couple of countries like France and Spain, where there has been a bit of a second wave of an infection. And the other thing I would say is that these are the headline PMIs, and the PMI, the sub-indexes for employment, have not done quite as well. They haven't had as sharp a bounce back, and that shows that firms are still a little bit reluctant to start hiring again. But let's move on now. This is another chart showing the contraction in GDP across the euro area. Stricter lockdowns mean steeper falls in GDP. So on a quarter-over-quarter basis, the GDP in the EU fell 14.2% in the second quarter, compared to about 10%, just below 10% in the US. But it's worth looking a bit at individual member states in Europe, because some countries have suffered a bit more than others. You can see here that Germany suffered an 11.5% contraction, whereas in Spain it was over a 23% contraction in the second quarter. So I think that, you know, some of the differences can probably be attributed to how strong and virulent the pandemic was, how many cases these countries had, because it did not hit Europe evenly, just as, in the US, it hit New York and some other cities first, and then only gradually spread into the heartland. But I think another reason is probably because countries like France and Spain, for example, had very large tourism sectors, and those took a pretty big hit initially. And if you want to think about, France and Germany, they both have pretty big manufacturing sectors, but in France, the aerospace industry is quite big, and that's taken a hit. So the country differences do start to matter, and it's worth paying attention to because it's the EU, like the United States, is a diverse economy.
Ben, if I may jump in with a question here real quick. So how are the member states coping with, they have less tax income, and, some of them have very, high expenses due to the shutdown. How are they coping individually? How they're getting organized amongst themselves? And how is the EU Commission supporting increased or the decrease in state member state revenues? Is there a mechanism that is falling into place?
Yeah, well, the first thing that the EU did was to suspend some of the rules on the activity. So this chart shows you that the Commission relaxed the state aid rules, and it also invoked the Greater Escape Clause, meaning that it suspended some of the fiscal rules for a temporary amount of time. And what this means is that, so everyone was confronted with this crisis, and member states immediately started to enact lockdown measures and activate their unemployment insurance programs and their short work schemes. We're going to talk a bit more about that in a while. But, this initial shock meant that governments in the member states were going to have to borrow more. They faced lower tax revenues, higher spending on social services. And so there was a need to do whatever it takes to get this pandemic under control and to try to cushion the economy as much as possible. So if we can, let's go back to slide 7, and I'll show you a little bit how the impact on the labor markets worked. The biggest single difference in the way that this pandemic has been experienced in the US and Europe is in the labor market, and it's the pandemic's impact on employment. In the EU, unemployment has barely increased. It's up at 6.5% now. It's gone up a tiny bit since pre-pandemic levels. But in the US, it was this huge shock. And unemployment, the headline unemployment rate hit 14.7% in April. But in fact, that really understated the true extent of unemployment in the US. It was probably closer to 20% because there were some methodological issues with how the US collects data, and a lot of people who had been furloughed and temporarily laid off were classified as employed when they shouldn't have been. There's been this big difference that the US is this flexible economy, unemployment shot up, whereas in Europe, it stayed quite stable. So you might be asking yourself, how's this possible? Well, the answer is due to these employment subsidies, these short work schemes. You might have heard of the German program is probably the most famous, the Kurzarbeit. But pretty much most EU member states have some variation of this. And what these schemes do is, when there's no work to be done, the state provides subsidies directly to employers so that they can keep their workers on the payroll during downturns. And a minimum, I think, it varies depending on country to country, but usually a minimum of 60 to 70% of a worker's prior wages he or she will continue to receive, and that will be subsidized by the government. So that is the reason. Yeah.
Is this sustainable? Because what I'm seeing here is that we are reaching a second wave of layoffs. So I was asking myself, while we have kept these layoffs from happening, prevented these layoffs, are we going to expect a round of layoffs in October in Europe, or what do you think this is sustainable?
Yeah, that's a very good question, because as these charts let's go back to the original chart, please, and then you can see that the charts that we were looking at on the employment subsidies, the blue columns, if we can go back to slide 8, the blue columns were showing that there actually has been this huge decline in the number of hours worked in Europe. And so the impact on the labor market, on activity, was similar in the sense that businesses were closed, they didn't need their workers, and that's why they stepped in with these short work schemes. And in addition, there's also greater worker protection in many EU countries that make it harder for firms to fire workers in the first place. But these are the things, these programs, these short work schemes stepped in and to support unemployment. And then there's this question, how long can this continue? Now, most of these short work schemes are meant to be temporary, and in most European countries, they are beginning to be phased out. But in Germany, they just announced, the government agreed to extend the short work scheme so that it continued to operate. In Germany, I don't have the numbers for every country, but in Germany, despite the fact that they have extended it, the number of workers on the Kurzarbeit has already started declining a fair amount. I think there was 5.4 million in German workers on this scheme in July, and that fell to 4.6 million. But that's still a lot of people. And these programs have done a lot to support household incomes. And so that's pretty important. But to your question, these schemes are meant to be temporary, and there are some issues with them. They're very expensive. And on top of that, some people say that, they prevent the economy from adjusting, because what happens is sectors that face long-term challenges to their business models, think tourism and travel and things like that, they're not going to be able to sustain as many workers as they did before. And the longer that these programs are in place, they discourage workers from actively looking for new jobs, which they're going to need to get because they can't go on forever. So there's some concern about that. We're going to see how things go. But this is where, in both the US and Europe, a lot of it comes back to what's going to happen to the pandemic, because the longer the pandemic lasts, the more infections there are, there's going to be a bigger impact on the economy and on the labor market. And we just have to see how things go. But for now, these programs have been very successful in supporting incomes and making sure that, workers can stay on the job and can stay engaged with their employers. And this is particularly important for industries that have highly skilled workers, where you don't want to have them, lose out on these skills and get disattached from their jobs and their employers. Maybe it doesn't work so well for smaller firms, but we've been using it there too in Europe. So we'll see how it goes. But it is a risk, because the shock to employment and activity has been about the same in Europe as in the US. So probably unemployment will go up a bit in the future. But maybe we can go now to slide 10 and just say a couple of things about this on the income point. The fact that household incomes have been supported as they have means that there should be a lot of pent-up demand, right? And so as things return to normal to the extent that they can, and you reopen businesses and people can go out again and go shopping and go to restaurants, people have money in their pockets and they will be able to spend it. And this hopefully should limit some of the permanent job losses. Again, it depends on what happens with the pandemic, but this is a good stopgap measure to get you over the hump. They're not meant to be permanent. But in the short term, they've been very important in providing incomes. So let's move on now to 11. The thing about, we showed you this briefly before, there was this big shock. All these short work schemes were implemented, but all these things are expensive, and member states started running big budget deficits. And so what were we going to do about this on a European level? Well, as we mentioned earlier, we suspended the state aid rules. We suspended some of the fiscal rules so that countries could run big budget deficits and provide some support to their individuals and their firms. One thing I would point out about the state aid is that a lot of what member states did was provided loan guarantees for companies so that they could maintain access to credit, borrow money, make sure that they could get through this these tough economic times. Now, these tend to be off-balance sheet items for member states, and so that means that they don't show up in the official, deficit figures, but they are contingent liabilities. And so if things last for a really long time and we start to get lots of bankruptcies, which is a risk, then these contingent liabilities, these guarantees will be triggered, and then it'll start to show up. But in the meantime, that hasn't happened yet. And the main focus of policy on the European level, both at the Commission and the ECB, is to be sure that everyone has access to liquidity, that sovereigns and companies can borrow money, and that they won't, fail because they lacked access to credit. So fiscal policy was supported by monetary policy in this regard. If we can go to 12, as in the U.S., the focus of the ECB was to maintain liquidity and restore market functioning as much as possible. So, because it's the benchmark interest rate of the ECB was already negative, they could lower rates further if they wanted to, but they in terms of providing liquidity, they decided to use other tools. And the biggest one was the Pandemic Emergency Purchase Program, but they also have these other tools like tiering and the TLTRO, the long-term refinancing operation, that reduces the cost of negative rates for banks in particular. And we can talk about that later if people have questions about it. But I would like to talk a bit about the PEP, the Pandemic Emergency Program, because that's really been the most important new policy tool that the ECB has rolled out. And you can see there that basically what it is asset purchases. The PEP now, they've got 1.35 trillion euros to spend, and the program is temporary, but it's going to run at least through June 2021, and it could get extended if necessary. And with the PEP, what the ECB can do is they can purchase both sovereign and corporate debt in the bond markets and bank loans as well. And they also have some flexibility in terms of how they structure the purchases. They don't necessarily have to follow the capital key, which says that they're supposed to maintain certain percentages of asset purchases from each member state. In practice, they pretty much have followed the capital key, but they don't have to if they don't absolutely want to. And the main reason for the PEP was to ensure that the ECB's monetary policy transmission mechanism continued to work, that borrowers had access to credit, and that they had access to credit at reasonable interest rates. And so this was a very clear message from the ECB when they announced it, that they were not going to allow any kind of financial fragmentation in Europe. They were not going to let spreads blow out. And basically what it does is it backstops the rates market.
And yeah, I was just I'm going to follow up on that, and that has really trickled down. That has worked. That has trickled down into the member states.
Yeah, absolutely. It's been very effective in making sure that governments can continue to borrow and fund their budget deficits, and that they can do so at rates that are cheap enough that it doesn't cause even worse problems with their budget deficits. So that's been really important. These charts show that interest rates came down after the PEP announcement, and sovereign spreads, particularly of Italian spreads, which has the biggest debt to GDP ratio in Europe, those came down. And so it was really a pretty big message and vote of confidence that the ECB was there to provide a backstop, and that they were not going to let markets become dysfunctional. And I think that really was well received in the markets. However, while it was successful in restoring liquidity, it hasn't had the impact yet of pushing inflation up. And that's ultimately what the ECB is trying to do, right? Get they want to maintain financial market stability, but their main mandate is inflation close to but just below 2%. And so what we can see here is that inflation has fallen. Headline HICP inflation was negative 0.2% in August. Core inflation fell to 0.4%. And that's a worry. Obviously, when you have a pandemic where you have the shutdown of activity, that's going to be a disinflationary force. And the question is, what is the ECB going to do in the long term? And I think that now that they've been successful in the liquidity provision and the crisis management, at some point they're probably going to pivot to taking steps to sustain and encourage the recovery and get growth and inflation back up. And I would just know, we don't know what they're going to do yet. They haven't announced it, but like the Fed, they're also doing a framework review, and that I think is going to be done sometime in the middle next year. And there's going to be other announcements before then of further steps that they can take. But they're going to need to do more to get inflation back up over the longer term. Now let's maybe pivot a little bit to the outlook. Despite all the support, all the fiscal, all the monetary policy support, the latest forecasts we have from the major institutions that do these things, the IMF and the Commission, they published some pretty bleak outlooks, as you can see here. The IMF is calling for a 10% decline in euro area GDP this year. Things are going to bounce back 6% supposedly next year. Commission's numbers aren't quite as bad, but they're not great. Almost 8.7% contraction in GDP this year, followed by a bounce back next year that won't bring us back to pre-pandemic levels. If I had to guess, I would say that when you see revisions to these forecasts in the coming months, you probably will see some upward revisions, but the outlook is still challenging, to say the least. It's not a great picture in terms of growth. And this is one of the issues here, is that even if we are moving out of the crisis stage and into the recovery stage, there's going to be some longer term legacies of this crisis. And one of the significant ones is simply debt. A lot of member states are going to have very high debt to GDP levels, and this is going to constrain their ability to continue to provide for a healthy economy and for healthy citizens. And not only that, but there's a big divergence in the fiscal health of the member states. Italy has very high debt to GDP ratios. It's going to be a problem for them to get that down. But if you compare that to the Dutch and the Germans, they are not constrained. Those countries are not constrained by their debt loads. And so this has implications for how the single market works, state aid, their ability to fund unemployment insurance. And this is really why European minds were so focused on the need to come together to build a recovery fund and to address these issues. And maybe with that, I'll stop, because I think this is a good transition point.
Yeah, I think, if I may just make a comment, I think what's really interesting is in how the different institutions like the ECB, EIB, IMF, and the other EU institutions all came together to make this a package that is flexible enough, yet addressing downstream the issues that the member states are having, and finding a more tailor-made solution than one size fits all. I mean, I'm not saying that one size fits all was the solution in the past, but this seems to be very tailor-made in its approach. How much flexibility, if I may ask you a last question, does the EU have to make further adjustments to this?
Well, I think the first challenge is to get the plan that they have agreed approved by the EU Parliament. But certainly the institutions are going to continue to tweak things going forward as conditions require. But it was simply the fact that people came to an agreement so quickly and so decisively, and with real money. Chris is about to tell you about some of the details of this, but it's macroeconomically significant, and hopefully it will be targeted, but it's going to require a lot of coordination between the member states, between the European Commission, between the ECB, and also including other institutions like the European Investment Bank that are there to help support the recovery and to provide guarantees to businesses and things like this. But it's big and it's significant. So with that, let me turn to Chris, because I think he's got a lot more to say on these topics.
All right,
Yeah,
Yvonne.
Chris.
Pleasure to be here as usual. Maybe let me just start from your last question. I think it's very interesting. In a way, there has been quite some tailoring, if you want, because what the Commission has done for the proposal the first time is really to make these funds available to member states to use them in their national schemes. So that was, for example, the case of this SURE instrument, up to 100 billion in loans, an envelope that member states could use, funds that the member states could request to fund their own national schemes, like the Kurzarbeit, like the chômage temporaire, like the Cassa Integrazione, whatever their national brand is. And all the schemes work very much along the same way as Ben suggested, but they all have their national tweaks, they all have their different coverages, and instead of coming up with a brand new thing that would harmonize across, what they made is like, okay, you can access these funds and then use them to fund schemes that are already working, right? So the idea is that if it's not broken, don't fix it, in a way. But at the same time, make these funds available. And this is for the SURE, but even more so with the ESM. The ESM is the big pile of money that was stitched up together during the previous crisis, the global financial crisis. And member states can access up to 2% of their GDP from this fund at concessional rates in order to fund investments related to the pandemic. So in healthcare directly, but also indirectly. So these are in a way quite innovative instruments, also because they don't come with the strings attached, or the very micromanagement strings attached that we were used during the years of the Troika and the programs. But ultimately the Commission was of the view that just making these funds available for member states to tap into would not be sufficient. There was, as Ben was referring, the divergence in the initial situation, in the starting position of the member states when this crisis hit was so big that this was really a risk that this would, in a way, start feeding a negative loop, and that member states that had weak fiscal capacities would not be able to put up as much fiscal power as the better off member states, and will fall behind. And then you keep having divergence dynamics within the European Union, and this is a risk really that the European Union did not want to run. Because you've seen this happening already during the great financial crisis, with so many countries falling behind because of because doing it by themselves meant that they had to sometimes implement a fiscal policy that was not optimal, that was suboptimal, that was not enough given the level of the slump. So, the idea that if a country falls behind, all countries are affected is really recognized and embraced in this policy package that the Commission came up with. And I would say that the Commission has been bold, but also lucky. If you can say lucky in the COVID times, bold because for the first time it's really proposing breaking a lot of taboos, if you want. Crossing some watermarks that were not been able to do so before, even during the financial crisis. The idea that, for example, the Union would borrow jointly and to redistribute money to the member states. The idea that this, most affected countries would be helped, and would be helped with grants and not just loans as before. But of course, and I will come to it, there are also some other elements of this compromise. But let me tell you also why they were lucky. They were lucky because in a way because of the timing. At the timing when the COVID hit the economy, that was was mostly March. The EU was really deep into the discussion about its long-term budget. And the budget of the EU, it's an extremely lengthy process, and it's not only the EU budget. Actually, as a matter of fact, it is the multi-year budget which covers a period of 7 years. And because the budget negotiations are so tough, back in the 80s, the member states agreed that they would do a framework budget for 7 years, a multi-year, and then within the framework have yearly budgets. But that means also that once you've closed the discussion for a 7-year budget, you don't open it again. But the bold and in a way lucky again move of the Commission was to embed this recovery instrument in its 7-year budget. And that is what we have here. So we had a multi-annual financial framework that the European Commission had proposed 1.1 billion. It came up very close to that figure. But then on top, the European Commission proposed this next generation EU for 750 billion that would be basically act as a top-up to this MFF. And mostly for the first 3 years of this 7-year period to make sure that this expenditure could be front-loaded and really help the recovery process. Now, in this...
Yeah, if I may ask a quick question. So it was also lucky in a way because we had all of these discussions about the Euro bonds and the pros and the cons. We already had this. And now at least that's the impression that I had. We've gone through the motions with them, discussed them, thought about alternatives, and now could implement them in a completely new way. Is that correct, or is that a misconception?
No, that is. I mean, I will get on the funding part later on, but I think what is very important here is that number one, what happened during, for example, the European debt crisis was that all these new institutions had to be put up together very quickly and very ad hoc way, and there was really a departure from sort of the legal framework of the EU, the way it was conceived by the founding fathers. And then you had the EFSM and you had the other instruments, and they were mostly intergovernmental. That is, a lot of backroom deals made by leaders without not a lot of scrutiny, and by really embedding this recovery instrument in the EU budget, first of all, it is a recovery instrument that serves the whole of the EU, not the euro area, as it was the case during the financial crisis. So in a way, it reduces some of the lines of fractures that had developed between EU member states that are within the euro areas and those who are not. But also it does this in an instrument which is the EU budget, which already exists, is trusted with the full involvement of the European Parliament, which makes it far superior from a democratic point of view. And then the overseeing of the European Court of Auditors and all these other elements that characterize the expenditure. So from a pure democratic and accountability point of view, it's so much superior, and it's really a step back to the origins of the EU, how it's supposed to work, if you want, as opposed to the intergovernmental euro area approach that we saw during 2011-2013. Let me just go a little bit into the recovery and resilience facility, because that's really the centerpiece of this recovery package, and there are a lot of innovative aspects here about how the EU is going to support its member states. So maybe I'll start with the governance of that. But so the idea is that member states, can access these funds partly as grants, up to 310 billion, and partly as loans. And that's really the bulk of the 750. Together they make 670 billion. The other residual 80 billion were top-ups to existing programs. So how does it work? It works in the following way. Basically, member states have to submit to the European Commission a plan in which they set out how they intend to use the funds. A big requirement, of course, the crucial requirement that these funds can only be used for investments. It cannot be used for funding recurrent expenditure, for example. And the two key words that you have to retain here is recovery and resilience. Okay, the two go hand in hand. You support the recovery, but by so doing, and the focus on investment, you also enhance the resilience, and therefore you reduce the risk that similar shocks would happen in the future or would have such an asymmetric impact in the future. So what are the other elements to make sure that there is a resilience? So we talked about the investment requirement. The other is that it really has, to tackle what are the future challenges. The COVID, we have seen that there are some short-term elements, but we have now tackled those. So now ahead of us lies, nevertheless, the challenge of the green transition and the digital transition. So these are two other key elements that will need to be featured in the national plans. And these requests for funds and for investments will have to come with a commitment to introduce reforms. So structural reforms, mostly in areas where member states have been dragging their feet for years before, and really sort of try to reignite the whole reform agenda. And the funds are really, there is a key to which that's how these funds are going to be allocated. And this key takes into consideration several parameters. Most important one being the unemployment rate and the deviation from the unemployment of the average of the EU. And then scaled to the size of the economy, if you want. And what we see is that the biggest share of the funds, this is the grant component, is going to be Italy, almost 20%, and Spain is just short of that. But of course, as a percentage of GDP, which you see in the red bars, that's quite small. It's smaller for Italy, right? So it's 20% of the whole of the fund, but just 4% of up to 4% of its GDP, and that's only the grant component. On top of that, you have the loan component. But for a country like Greece, and Ben was referring to that, these very hard-hit countries that are so reliant on tourism, the share of the fund is smaller. It's 6%, but because the Greek economy is so much smaller than the Italian one, it represents up to 10% of GDP, which is just a massive investment. So, ultimately, the member states on top of that will have to come up with some measurable benchmarks and targets and quantitative targets that will allow the Commission to say, well, you are implementing the plan according to how you have set it out, and therefore release the funds. And so ultimately, this is a form of quasi-budget support. That's the way, which is a very new way of implementing the budget, with respect to the traditional funding schemes of the European Union. Also, so the funding is mostly through the borrowing, and this borrowing of 750 million. And I see we're running a little bit of time, so I will maybe pick up a bit of steaming going forward. But there are also the Commission was also tasked by the Council to explore a number of avenues to raise some additional revenue that could accrue directly to the EU budget. But here is the very the important thing about funding, which is it has, if you want, a dual benefit. The part of the benefit of the funding is that it makes the money available. The EU has been issuing debt before, but up to now there's only about 50 billion on the market up to 20, and with the longest maturity in 2042. This 50 billion is going to become 800 billion or 850 billion in the next few years. So there's just going to be a huge injection of bond in the market, right? And basically what we already have a yield curve for the EU funds, or sorry, for EU bonds. But this yield curve is going to be radically transformed as, of course, this bond becomes so much more liquid. There's so much more of them, and this bond has the future really or the potential to become the safe assets that so much was discussed about during the euro debt crisis. A euro-denominated asset, which is for the whole of the EU, very liquid, with of sufficient magnitude that you can actually construct and build a whole yield curve around it, which will have a lot of important also for the international role of the euro, which is another objective this Commission is pursuing.
Yeah, I was just going to ask you that. How is that going to affect the exchange rate or the exchange rate for the euro?
So, I mean, we have seen a lot of movement in exchange rates just in the past 2-3 months, and we've seen a lot of appreciation of the euro or vis-a-vis the dollar. I mean, part of that is explained by a weakness of the dollar in this moment. But it's true that the euro has been appreciating not only against the dollar, but also against other currencies. And part of this just reflects that there is so much more confidence, I think, that Europe will be able to tackle this crisis in a different way, differently from how it tackled the euro debt crisis. It's going to really come out in stronger because it's addressing the recovery, but it's also planting the seed of a stronger union, and that is doing it because of this safe asset, because it is using the budget, because it is helping more affected and weaker member states, because it's really embracing this solidarity, and all these aspects are really going to be crucial, and because also it's envisaging some future revenue streams that could accrue directly to the EU budget, and all these elements, sort of are all together make that the EU is coming out stronger. And this leads me to my closing slide. There's been a lot of discussion in the media, in the papers, article whether this is a Hamiltonian moment for Europe, and of course Hamilton is here on the $10 bill. And for those who do not know or who have not seen the musical, Hamilton brokered a deal for consolidating the debt of the states coming out of the War of Independence, and this moment, as most economists and historians agree, has been really fundamental and really important in creating the financial market in the U.S. and centralizing power at federal level and the prosperity of the U.S. So I don't know if this is how our 10 euro bill is going to look in the future with Ursula here. But we are not consolidating debt. It's debt that we are creating. It's a temporary instrument. However, we are going back to this community method. It's for the whole of the EU. We are creating, at least for the next decades, a euro area safe asset, and I think it is an important precedent in the way the EU will tackle also future crises.
Yeah, do you think the EU is ready to take on that role, or a more the euro taking on a role like a major exchange currency on par with the dollar currently?
On par for the dollar, I think it's maybe it's a bit too much. This is not the objective, but it's clear that for the EU, an international role for the dollar, it's part of how it envisages its strategy to protect its power also outside of the EU. And we have discussed this about before, but the over-reliance on the U.S. financial system, especially when the U.S. are taking so many measures that that are extraterritorial in their sanctions, etc., constrain the policy states of EU, and having a more less of dependence from the dollar is one of the strategic objectives. As ultimately, it will depend on how much appetite there will be for the bonds and who will buy it. It will be how much central banks, how many institutional investors, and maybe Ben, he can say a bit more about this.
Yeah. Thanks. I think it's true that this is not a true Hamiltonian moment because we're not consolidating debts of member states at the European level, but the introduction of these EU bonds is really significant. And the EU has borrowed before, but it's borrowed not that much money, and it's been treated as one of these supra sovereign issuers in Europe, similar to the EIB or the ESM. But this is really a significant amount of money. The Commission could be the single largest issuer in European bond markets next year. We don't know what the exact plans are, but they're going to issue something like 150 billion euros worth of bonds. And that's real money, and it's going to have a macroeconomic impact on the spending side. But in terms of financial markets, as Chris was saying, they're going to issue across the curve. And so you're going to have an asset that trades, they're probably going to roll it out initially in the belly of the curve, because that's where most of the demand is going to be. But as they ramp things up, what's going to happen is that probably EU bonds are going to trade much more like a sovereign, like German bonds or French oats, where you have regular auctions every month in size, where you are not using banks to syndicate the purchases, with special buyers. You're going to have a lot of demand. And one thing I would note is that the EU has AAA credit ratings from Moody's and Fitch, and they're AA by S&P, but they could get upgraded, actually. And if you think that this money is going to help the recovery, I think you can make a pretty credible case that there should be an upgrade. And so that opens up a pretty large world of mutual funds and pension funds that can buy this debt. It's also, for regulatory purposes, treated as a tier 1 safe asset. So that means that European banks can use EU bonds as a reserve for regulatory purposes. So they're going to be buyers. You've also got QE, and the ECB could further adjust the way that it conducts its asset purchase programs and provide an extra bit of support. So this is really set to transform the way European financial markets work over the next couple years, and that's going to be really important.
Yeah, I was just going to say, I mean, that is a huge development that will have massive microeconomic effects on the capital markets union, maybe a fiscal union. That's remember, we're still talking about that, and also as an investment vehicle. I mean, this is a game changer, don't you think?
Absolutely, Ivan. And just also, talking back about that fiscal union that you just mentioned, I mean, the schedule for the moment is that this pay will have to be paid back between 28 and 58. So but there is a big likelihood, at least, that member state will also consider at one point that there are additional benefits just to have this debt out there, and instead of paying it back, they might consider to keep this instrument there because of its beneficial impact to the financial markets, and also at the same time pay the liabilities that it generates by creating some common tax base. And there is digital taxation, there is some border adjustment mechanism for carbon. And levy on non-recyclable plastic. I mean, these are all avenues that are going to be explored in the months to come. But for the time being, we have this, and now I think it's up to the council to really seal this deal, to get it approved formally, because this is just a high-level political agreement at this moment, and then we can move also into getting all the secondary legislation into places so that we can hit January, can hit the road running, and we can start disbursing. Because the idea is that already under this recovery and resilience facility, 10% can be disbursed in the first year, or immediately, actually. So up to 70% of the whole fund should be disbursed or committed, in the first 2 years. And Ivan, I'm just gonna remind you about the polling before we.
I was just going to say that we have.
Wait, before we do the polling, I think there's one point that I'd like to add that we should have discussed maybe a little bit more, but it's not too late, and that's just on the Green Deal.
Read all of the question, but we're going to launch the poll now, and we invite our audience to answer the question. And we have one question, maybe we can address that while we're waiting for the poll results to come in. If the AAA rating is officially granted, is that Ben or Chris? Is that official?
Yvonne, there's another point that I'd like to make first, which is just on the green, which is that while this money, the main focus is on the recovery, it is also, the money is also going to be spent with an eye towards the longer term goals of Europe, and having an environmentally friendly climate change policy is a big priority for Europe. And member states, when they submit their plans for how they're going to take the grant money and the loans and how they're going to make these new investments, the roughly 30% of this money should go to some kind of green objectives. Now, we'll see exactly what these member states come up with, but it's going to be a significant amount of the money is going to be spent on infrastructure and technology that's going to lower carbon emissions and things like that. And this also gives Europe the option of packaging that funding into green Eurobonds. And it's very likely to be the biggest issuer of ESG bonds next year. And it could really provide core backstop for that market and get a lot of people interested, because it is a safe asset, it's going to be green, and the EU already has AAA from 2 of the 3 ratings agencies, and S&P is just AA, which is just one notch below. So you could get a big upgrade there too. But the green aspect of this funding and financing is also something that's worth highlighting.
Yeah, it's pretty brilliant. I have to agree. How is this all tying in with the InvestEU scheme that the EIB had developed together with a commission? Does that tie in directly with one another, or is this an add-on on top of it?
So maybe I'll say something about that. In the original, and I don't see you anymore for some reason, but I'll just keep speaking. I hope you can see me. The original plan of the commission was also, the suggestion was also to increase a little bit the budget for the guarantees to give to the EIB, so they could boost their InvestEU program, which is really sort of the continuation of the Juncker plan. And the council didn't seem to really agree on that. So that part of the proposal was taken out. But what is interesting is that actually the council has invited the board of the EIB to consider whether they should not increase its capital in order to even expand its volume of activity. And the EIB is very much in favor of this solution. So we will see what will happen in the years to come. But it is clear that the EIB has this ambition of becoming the climate bank of the EU. And we also know that this transformation, there is a part of public, but we need the buy-in of the private sector, and an actor like the EIB can really help in steering that credit policy in order to make sure that you can attain this objective with the help of the private sector.
Yeah, thank you for that. We have a question regarding workforce. Is there an expectation that older workers might be placed on early retirement schemes to level out potential unemployment numbers?
I mean, there will be a variety of instruments. I mean, these policies were really used a lot in the 80s. I think there is an experience that they tend to be very costly. I don't rule out that in some sectors there could be some recurrence of that, but this is not the way I mean, the accent has really shifted at the EU level from active labor market policy. You know, the retraining, making sure that you have a labor force that is apt to the skills and the needs of the economy, not put and just park them somewhere else.
Yeah, we are over time, but I have I see another question that I think is quite interesting. So this all sounds all you know, very positive, and you know, Europe being on an upwards trend. But how is this all going to develop if the growth rates in the US are not keeping up? How are we going to deal with that if our friends in the US, our most important market, is not up there with us?
That's a great question. I mean, the EU values the partnership with the US beyond any other partnership, and you know, it's a community of values that goes far beyond just the pure size of the market. For us, I mean, we have seen how, you know, the recovery in the US during the great financial crisis and even in this past years has been so important, despite some of the trade tensions in supporting also growth in the EU. So what will happen? We keep watching, of course, what happens in the US with a lot of interest, and you know, we hope that the growth will come back as strong as it was before. And in order to really get all the benefits of that, the EU is still, you know, open for business, open to engage, and you know, it is engaging in this very moment for you know, going forward to have a trade deal or better trade deal with the US, so that we don't get some of these disturbances that we had in the months before, and we can make sure US and EU get the most benefit out of this huge transatlantic partnership.
Yeah, and if I could add to that, I think, you know, the whole world is really in the same boat with the pandemic, and you know, things won't be able to go back to normal until there is a vaccine anywhere, not 100%. And so everyone is facing the same situation and needs to work towards finding a solution to that as the top priority and job number one. But I would also say that, you know, the experience of this pandemic, in contrast to the financial crisis and the Great Recession, that crisis showed some of the shortcomings in the design of Europe's you know, single currency and single market, and prompted a lot of reforms in Europe that are still ongoing. This crisis, I think, has really highlighted some of the shortcomings of the social safety net in the United States. And you see things like, you know, the US Paycheck Protection Program was sort of an ad hoc attempt to create some American version of the Kurzarbeit and these other short work schemes. And, you know, it helped, but it didn't work quite as well because it hadn't been in place and ready to just be turned on. And I think that we still need to deal. So on the one hand, there are some lessons this time for the US from the European experience, positive lessons in terms of these are some of the ways that you can design social safety net institutions that really work pretty well. And on the other hand, I think I would just say that, you know, the nature of this as a global pandemic means that really highlights that a lot of the challenges, whether it's public health, whether it's the environment, whether it's trade, really need to be sorted out on a global level through multilateral organizations and a rules-based international system. And so, you know, hopefully that will be one of the key lessons that people take away from this, and you know, that we can come out of this stronger eventually when we're able to do so.
Yeah, an issue right up my heart, because that's what the EACC does. We're bringing back together Americans and Europeans to grow better together. And with that, I think we've reached the end of the program. One note to our members: if you're a member of the EACC, we're sending around a list of the attendees of today's program. And we encourage you to reach out to us if you want to connect to any of them. And also, if you have additional questions for the panelists, send them to us, send them to your chapter representative, and we're happy to get some answers to you for that. With that, I hand over to my colleague Todd. Thank you for hosting us on the platform today. And Todd, over to you.
So that concludes today's webinar entitled Navigating the Recovery, How Europe is Coming Out Stronger from the Pandemic. Thanks again to our presenters, Christian Orsini and Ben Carliner from the EU delegation to the United States, and of course to our moderator and my colleague Yvonne Bendigo-Rothschild, the EACC chapter in New York. Just a reminder, all comments and opinions presented by our speakers today are their own and do not necessarily represent the views of the European American Chamber of Commerce or its members. Please stay in touch with your local chapter, as Yvonne said, of the EACC for information on upcoming events and webinars. And be sure to look for a recording of this and our other EACC webinars and events on our YouTube channel. Thanks again for joining us, and farewell.
Thank you.
Thank you.
Thank you. Thanks, everyone.